Are you tired of taking massive losses? Chances are it's because you're entering with fair value gaps instead of order blocks. So in today's video, I'm going to teach you how to minimize your losses and maximize your profits by trading order blocks. Welcome back to my channel. It's your boy Zeus. Let's get straight into it. In this video, you're going to learn what is an order block, how to identify them, and how to trade them. First and foremost, if you notice the left-hand side chart here, you will notice we're in a series of higher highs and higher lows. Now, what creates an order block is either a single down close candle in an uptrend or a series of down close candles in an uptrend. So notice here how we expand to the upside, we get that slight retracement, and then we get the expansion back up. Now, on the next wave, notice where we retrace back into, this most recent down close range. Now this right here would create your bullish order block, signaling that buyers are respecting the last down close candle or series of down close candle before we see a higher high. The thing is, you have to understand that smart money does not want to buy the highs. They can easily buy the highs, but ideally they want to push price down. So that's the significance of order blocks. Smart money will not look to buy prices above this range. They would much rather take price back into a discount range. Notice where we retrace back into. We retrace perfectly back into discount range. Now, I will be making a video covering discount range and premium, so make sure to follow and make sure to turn on that notification so you know exactly when that video comes out. Now, notice here what happens. We come back into this order block. Likely there's a fair value gap period within this order block, and then we get our expansion back up. Not only that, notice how we repeat the same cycle once we start expanding up from this range again. Once we start to retrace, where do we retrace back into? Likely into a discount range, also paired with an order block before seeing more upside. Now, if we take a look at the right-hand side, what do we notice? We're currently in a downtrend. Now we get some slight retracement back up, creating a bearish order block. Here's our bearish order block from this most recent range. Now, with this example, notice how we start to retrace back into this order block, but we don't instantly displace. Oftentimes, you're going to see this type of price action where price is kind of stalling out or consolidating around this range and likely waiting for a liquidity sweep. Notice how we sweep liquidity at this level, and then we get the expansion back to the downside. Now let's go take a look at a couple live examples. Now, looking at this chart, what do you notice? It's very, very important that you have context of the market. If you are not trading overall with market structure, none of these concepts that you know will work out. So it's very, very important you're aware of what the trend is. At this given point in time, we can see we are currently in a downtrend. Why do we know that? Well, we're getting a series of lower highs and lower lows. We have failed to take out any of the highs, pretty much signaling we are likely to expand more to the downside. Now, notice this single up close candle here. This creates your order block. Now, for me personally, I only like to mark out the body of the order block. The body is all we care about. I don't necessarily care about the wick, and the reason for that is because oftentimes I rather use the wick as my stop loss opposed to the wick being part of the order block. So when it comes to entering order blocks, first and foremost, like I said, have context of the market. What is market structure doing? What is the trend doing? Notice how the hourly is bearish, the daily is bearish. Next, we want to figure out, well, what is our current drawn liquidity? Well, we have a low here. Not only that, but if we look further back to the left, notice how we have another low at this level. So make sure you mark out your drawn liquidities as well. If you cannot identify the drawn liquidity, I would not take the trade. It's not worth it, because chances are you're probably gambling opposed to trading with a process. So now that we've identified the trend and we have identified the drawn liquidity, now we want to go look and see how can we enter this trade based off of this order block. I prefer to actually enter the order block based on the body and use the wick as the stop loss. Now, however, you can also use 50% of the order block for entry as well if you want to have a tighter stop loss. But as long as the trade equals above the 2-to-1 risk to reward, I am willing to accept the body of the order block for my entry. So in this example, this is obviously a bearish order block, and now let's play it out a bit. Notice how price retraces back into this range. And if you also want to add more confluence, notice the hourly power of 3. What occurs here? We retrace back into this range, ultimately us entering on the wick. Why is it the wick? Because if you notice, the open of the most recent hourly candle is at 19,371. So when it comes to entering trades, ideally we want to be entering on the wick of the hourly candle if we're trading a lower time frame setup. And if we're trading a daily setup, same thing. We want to be entering below daily open. Now, notice here, price retraces back into this order block. Do we ever see a body close above this range? As long as price fails to mitigate this candle, we are likely going to see more expansion to the downside. Now we need to identify, well, what is our drawn liquidity? We have one drawn liquidity right here, but notice how this is not a 2-to-1 risk to reward. So I would not look to trim at this level. Our next drawn liquidity is down at 19,159. Notice how we're getting the expansion, and notice how we hit that drawn liquidity and buyers start to step in instantly. That's why it's very, very important that you trim at your take profits. We do not care to be greedy whatsoever. Once we can identify an A+ setup, we execute on it and remain disciplined all the way through. Now let's look at another example. Now we're looking at NQ again, but this time here is a bullish example. Notice what is market structure doing. We have context that the trend is currently up. Next, we want to identify, well, what is our drawn liquidity? Well, notice how we have buy side liquidity right here. So now that we've identified what market structure is doing, what the trend is pretty much, notice the bullish candle, notice the daily power of 3, notice that it's bullish. So at this given point in time, we have to identify, well, what is this daily candle looking to reach? Once we can identify that, we pretty much have an A+ setup. Now, notice here, we have a singular down close candle that is in a clear uptrend. That creates your order block here. Now we want to expand the order block to the right and wait for price to retrace back into this range. It's very, very important you're not chasing these order blocks. You must see price retrace back into the range. You never want to chase a trade. You always want to see it come back and respect your levels. So now at this given point in time, let's just say you didn't enter on this retest. Let's play it out a couple candles and see if we can actually get a retest. We already know what the drawn liquidity is at 19,914. Now it's up for us to find an entry model that's going to take us there. Put your entry at the start of the order block, put your stop loss at the bottom wick of the order block, and put your price target at the current drawn liquidity. Notice how we have a 2.16 risk to reward. That is an A+ setup. Anything over a 2-to-1, you want to execute that trade 100% of the time, because you only need a 34% win rate to be profitable if you're executing on 2-to-1 risk to reward trade setups. Now let's play this out. We perfectly get wicked in here. However, we can see we get another entry right here. Now, based on that alone, you have multiple opportunities to enter this trade setup. At this given point in time, we are just consolidating. And what does that mean? Anytime we're in an uptrend and we're consolidating, that's likely telling us we are just consolidating because price is going to expand yet again for another wave. Remember, the market can only do one of 3 things: expand, consolidate, and retrace. So anytime you see consolidation, don't let that scare you. Save your ammo and wait for price to expand. Boom. Notice how we get a very good entry. And at this given point in time, we can clearly identify that this was a manipulation leg. Now let's go ahead and draw our fib level and make sure, where did we manipulate to? Notice how we manipulate back into discount. This is an A+ setup order block. The reason behind it is because smart money will never want to buy the highs. Smart money necessarily wouldn't even want the entry here at 19,800 pretty much. Smart money rather enter the trade setup back into a discount range, which we get here. Now let's see if we can get the expansion up. At this given point in time, notice how we're still respecting the order block. All of this current price action is nothing more than consolidation. Do not let consolidation shake you out of a winning trade setup. It's either your stop loss hits or your PT hits and nothing else. Like I said, as long as you're taking a 2-to-1 risk to reward trade setup, all it takes is for you to win 34 trades out of 100 trades to be profitable. That is fairly easy. Anybody can have a 34% win rate. Now notice, what are we doing? We're starting to get that expansion out of this range, signaling that this consolidation phase is now over and we are currently going to see that push up to the current drawn liquidity. If you're currently struggling to become a profitable funded trader, then I have some great news for you. I'm now offering a mentorship program that will teach you everything you need to know from start to finish. Regardless if you're a beginner trader or have been trading for years, my mentorship program will help you become a profitable funded trader by covering the 3 pillars that will lead to your success in trading: psychology, risk management, and strategy. If you're ready to become a profitable funded trader, click the link down below, fill out your information, and book a free discovery call. I'm looking forward to seeing you guys inside. Now let's get back to the video. Looking at gold here, what do we notice? We are currently starting to get that market structure shift here, starting to shift us back into an uptrend. We got our market structure shift right here once we broke above 24,000. Now we need to identify what is the current drawn liquidity. Well, notice how we have these highs at this range right here at 2,432. So that is our current drawn liquidity. Now, what else do we notice? Notice how we have this singular down close candle and an uptrend. That creates your order block. Now we want to wait for price to retrace back into the order block range to target 2,431. I personally like to put my stop loss at the wick that creates the order block. If price does wick me out of the trade and starts to respect the order block yet again, I'll just enter the trade again. But I think it's very, very important when you're trading, especially Forex or futures, that we have a very tight stop loss, because we all know if you take too many contracts or too many lot sizes, for an example on gold, and price starts to retrace all the way back down, potentially even into this order block, that's a pretty big stop loss. So to minimize your risk, put your stop loss at the bottom of the wick that creates the order block, put your entry at the body, and identify your price target as where the most recent high or most recent low is. And as long as the trade setup is over a 2-to-1 risk to reward, you take that trade setup 100% of the time. Now notice here, we have a 13.1 risk to reward trade setup. You don't see too often, but when you do see them, you want to pull them 100% of the time. So let's play this out a couple candles. Notice where price comes back into the order block. Notice how it comes a pip away from actually stopping us out. But do we ever get stopped out of the trade? No, we do not. That's why it's so important that you actually wait for price to retrace back into these ranges before entering a trade. You never want to be buying the highs or buying the lows, because like I said, smart money concepts is not buying the highs. They're going to manipulate retail out of the trade, come back into the order block, and then expand back up to the drawn liquidity. Now notice here, once we close above this singular up close candle, that offers your change in state of delivery, which is signaling that buyers are now here. Now let's play this out more. Notice how we're respecting nothing but bullish price action here. We're consolidating. Remember what I talked about. Anytime price is consolidating, very likely we're going to see more expansion to the direction of the overall trend. We get the retest of this most recent consolidation range, and then boom, we hit buy side liquidity. I hope this video helped you guys a lot. Make sure to subscribe, like, and comment what you guys would like to learn next. I'll see you guys in my next video.